All right, so we're just going to do a quick Sunday wrap up. We're going to do a reflection of what has recently taken place. If you guys have been tapping into the Zoom calls and the fundamental reports, then everybody should be up to speed. If you're not and you have not caught up with the recent reports, i.e., everything that we had touched on last week, going over the Zoom calls, accurately analyzing why the market shed over $330 billion from September highs. Make sure that you guys just go back and reflect on those Zoom calls so that way you're up to date and you understand the environment that we're trading in and heading into. Also going over some of the risks that still remain lingering. Primary risks, right? There's obviously, of course, always those things and events that could pop up that we're not paying attention to, but the primary things like easing monetary policy, liquidity conditions, geopolitical tariff-related tensions, central bank policy positioning, Fed speakers, Bank of Japan speakers, so on and so forth. We've been covering as our primaries, and we've gone over those in past fundamental breakdowns and Zoom calls. So if you're new to this community, make sure that you guys are taking advantage. I love seeing people like Katie the other day in the chat said that she takes the time and she has gone back and watched all the Zoom recordings and has learned so much information. And I encourage you guys to do that, right? There's like over 400 freaking Zoom recordings. And even though they're not updated Zooms, there's just so much valuable little tiny tidbits of information that you guys can take away to just help you develop as a fundamental analyst and as a technical analyst in your trading and investing career. Even if you don't trade, it's still good to go back and watch those. So we're going to cover this report today, the 28th report. I'll drop it in the chat for you guys after, so that way you can make your own analysis of it and read thoroughly through it, so you choose to do so. But let's go over this. I have a bunch of screenshots from some fundamentals that I gathered from this Risings update. Just kind of taking a look back at what took place last week, where we're at, what the market was pricing in, what shifted all that sentiment, and then catalyst and key drivers that will likely move and sway market conditions moving forward into this week. So that way we can prepare and walk through some if-then scenarios. All right. So starting at the top of this and reading down. Over the past week, markets have dialed back slightly the expectations of aggressive Fed easing heading into 2026. After the September FOMC meeting, Chair Jerome Powell acknowledged that inflation still remains sticky and troublesome. Even as hiring is continuing to slow, this is eerily similar to the December 2024 scenario that had taken place when a hawkish rate cut and tariff tensions triggered the pullback heading into 2025, which we went over in detail in our September 21st Zoom call, if you guys want to go back and watch that. And we are now starting to see the possibility of this pullback deepening if the data continues to push back on the rate cut narrative. So you can see here, this is a report that I gathered. I think it was from Coin or Chain Analysis. I don't remember particularly where this report came from. I'm pretty sure it was Chain Analysis, but this was from Saturday. Okay, this is a report, a screenshot that I had read on Saturday, and we had talked about this in detail Thursday and on the 21st of September. So just showing you guys that we're always beating the retail crowd. And look what they said in their little tiny key highlight. This wave of recent liquidations and forced closures of over-leveraged trades in crypto has been the biggest since December 2024. Says here, largest in the crypto market since December 9th, 2024. These are leveraged positions closed by force, most over-leveraged longs on ETH. And it's just interesting because in this community, we talked about when the last top or the local top had taken place in the market, and that was exactly December 2024. And if we go back and we look at historical context, here's December 2024's headlines. You can see this was a hawkish rate cut issued from the Federal Reserve. You can see it in the headlines. Hawkish cut slams risk appetite. If you go and you look at the date, you can see here the context. This was December 18th, 2024, same date as the hawkish rate cut, slamming risk appetite, and that initiated this extensive pullback heading into 2025. Then if we come down here, this is a September 2025 report. It says right here, Federal Reserve Chair Jerome Powell on Tuesday signaled a cautious approach to future interest rate cuts, setting up a sharp contrast with other central bank officials who are calling for more urgency in responding to a weakening job market. So pushing back on the rate cut trajectory, you can again see how that is reflected in today's prices. This is the local top, September 17th, 2025, same date as the FOMC press conference when everybody, all the retail traders thought that when the Fed cut rates that the market was going to rally higher, and it actually did the inverse, right? So it was a buy the rumor, sell the news event, all right? And we touched on that. So what was the market previously pricing in? That's important to know moving forward. And what did the Fed stance and why did the Fed stance weigh on market sentiment? So here you can see a report. I believe this was from Reuters, and it says the Federal Reserve is projecting only one rate cut now in 2026, which is less than what the market was expecting, according to its median projection. Traders were currently pricing in, this is again prior to the FOMC, traders were pricing in 2 to 3 more rate cuts next year, according to the CME Fed Watch tool. And so when Jerome Powell came back and dialed back those rate cut expectations heading into 2026, just like in previous cycles, markets have to reprice that in. They have to readjust their risk, and that leads to more demand for safe haven assets and temporarily less demand for risk assets. So markets have been pricing in 2 to 3 cuts next year, expecting the Fed to keep easing aggressively, but the Fed's latest projection shows only one cut in 2026, a much more conservative path. That surprised investors and weighed on risk sentiment because fewer cuts mean higher borrowing costs for a prolonged period of time, making making cash and bonds more attractive than riskier assets like crypto or growth stocks. Historically, we have seen how this shift can quickly dial back capital flows into risk assets as traders reprice expectations and hedge for tighter financial conditions for a prolonged period of time. So, here in this community, we are firm believers, at least I know I am, that these pullbacks are likely to remain temporary, that we are in a historically changing contextual extended bull market cycle, whatever you want to call it, like whatever you want to put behind it. I mean, the charts don't lie. You can clearly see that since 2022, collectively speaking, we have been in a bull market. Prices have been going up, historically speaking, depending on what specific altcoins you're looking at. We're just looking at the total market cap as a whole, and we have been going up since 2022. However, these drastic retracements can last months, sometimes 6 months, like this one was for, sorry, wrong tool. This pullback lasted 179 days, right? So this can seem, especially when all the headlines are coming out, like, oh my gosh, we're entering into a bear market cycle. Fear, uncertainty, and doubt is an all-time high. There's geopolitical tensions in between here and then. There's all types of escalations and headlines. The fear and greed index is below the 50 grade threshold. Things can get pretty gloomy. But overall, the underlying fundamentals in crypto have not changed. We've actually never been in an environment like the one that we're in now. And so I'm going to continue to grip onto this narrative that even if we were to see a deep retracement, like for example, the one that we're kind of seeing reflected in headlines today, that reflected itself back December 18th, 2024, that lasted 115 days. We could be entering into that type of environment. And so if we were to just take out a measuring tool, so let's just average that at about 100 days. The first one was 169, the second one was 115. Let's just say 100 days. Well, let's draw that out. 100 days from the top at September 17th, if the market does continue to retrace from here, would put us at around the end of this year into the beginning of next year, January. So sometime after the holidays, before we start to really see the market rekindle itself. And that's again if the sentiment continues to worsen and the decline continues to deepen. All right. So just be mindful of that. Don't believe everything that you see on social media that we're going to rally higher. I hope that the underlying fundamentals shift back to risk on sentiment, that we find a floor at $3.6 trillion or August lows and we rekindle the losses and continue the uptrend. And instead of a deep retracement like we saw back in 2024, beginning and end, we see a slight retracement like the one that we saw mid 2025. Again, wrong tool, excuse me, which only lasted 33 days before the market made another substantial leg higher, right? So I'd rather see a pullback like this than ones previously existing. But again, nobody has a crystal ball. So moving on. Um, Recently, we've seen inflation come out well above the Fed's 2% target. The breadth of price increases is showing signs that right now the share of PCE and CPI items are rising more than 2%. And that recently has climbed sharply. PCE came from 56% up to 65%, CPI from 63 to 76%. Tariff-related price spikes are also starting to fade, meaning inflation pressures are possibly now homegrown rather than one-off. That is extremely important right there because remember, a lot of the Fed speakers in most recent times have hinted that tariff price increases could just be a one-off event. Well, if we start to continue to see higher inflation every single month, month after month, it's going to continue to weigh on the rate cut trajectory, and it's going to show that the Fed speakers aren't necessarily correct, and the market's going to shake that out. They're going to stop pricing in aggressive easing, and they're going to start to prepare for a higher for longer interest rate environment, right? And then also, I didn't even talk about this in this report, but if we were to see an environment where inflation started spiraling out of control, we actually could be in a really bad situation where in 2026 the Fed actually needs to hike rates, which will completely throw the current market sentiment off and scale back risk on sentiment substantially. But we're not there yet, so I don't want to spook anybody with that scenario. So we're not going to talk about that right now. So the combination of broad-based inflation and slowing payroll growth has left the Fed straddling its dual mandate of price stability and maximum employment. The coming labor data this upcoming week will be critical for risk assets. So I've always tried to give you guys just a little bit of an easy visualizer. So key releases that we have this week that are going to be of our main focus for headline data releases are going to be the JOLTS job openings figure, the ADP private payroll figure, the initial jobless claims, and then obviously, of course, Friday's non-farm payrolls and unemployment rates. So right now, the market is showing signs that JOLTS job openings is going to come out lower without a spike in layoffs, showing signs of healthy cooling. ADP private payrolls is set to show signs of softening, but not a collapse, keeping the Fed easing alive. Initial jobless claims is set to show a gentle uptick, not a surge, which would support gradual easing. And right now, Friday's non-farm payrolls, the consensus is anywhere between 43 to 75,000 job increases. A print that would be inside this reading would signal enough cooling for cuts without recession panicking. So we'll get into this in just a second more in detail. The ideal scenario this week for risk assets, however, this is what's important because anything outside of this scenario is likely to lead to consolidation, no further increase in prices, or downside pressure. So anything outside of this scenario is something that we're going to be mindful of and that we would not like to see ideally. The scenario that we would like to see is job openings declining modestly, hiring and payroll prints between 40,000 and 75,000, maybe even slightly lower, but nothing showing signs of substantial deterioration, sparking recessionary fears, cooling enough to keep the Fed on its toes for rate cuts in the near future. And unemployment rates staying near 4.3% or ticking up slightly to 4.4%. This would keep the door open for two more 25 basis point cuts in October and December, and would give investors confidence that the Fed can stay dovish without stoking inflation. To the upside, this would be obviously, of course, more bullish for the dollar and less bullish for risk assets. So if we were to see a strong upside surprise in NFP figures or any of the other labor market data that we're set to get this week, like JOLTS job openings, private payroll figures, or initial jobless claims. So NFP, anything higher than what the market is currently expecting, or a plunge in jobless claims, so anything lower in jobless claims than what the market is expecting, would likely fuel the dollar and push back on rate cut bets. So just looking at some of these reports to give you guys some context, it says the importance of this jobs report, the last before the Fed's next meeting, which isn't until October, I think 27th or 28th, it's at the end of October, is heightened given the central bank has no risk-free path ahead. as Fed Chair Jerome Powell described it in the past week. In a note on Friday, the team at Oxford Economics said that they expect the U.S. economy is going to add 85,000 non-farm payroll jobs in September. This figure, the firm wrote, should reassure that the Federal Reserve, should reassure the Federal Reserve the labor market is not deteriorating, allowing the central bank to keep policy on hold at its October meeting. So the reason why I added this one is because this is well above what the current market consensus is. If you go and you look at forex factory, you go to the calendar and you look at this upcoming week and you scroll down, you can see here the non-farm employment change. The previous reading was 22,000 jobs were added. The market is forecasting 51,000 jobs are added. And so if we saw this data figure come out when the actual reading prints and it read 85,000, well, this data report right here is giving us context to show that if the jobs report shows 85,000 jobs were added, it's likely going to push back on the notion that the Fed is going to be able to ease in October. And we know in this community that's likely going to lead to dollar strength, consolidation, or sell pressure in risk assets, right? As right now, key drivers of risk assets, particularly like crypto, are easing liquidity conditions. And so if that expectation is dialed back, we're likely to see no further upside pressure in risk assets temporarily, right? Then here, this also reads, this is an ING report. It says rate cuts aren't a quick remedy to all of that, but equally a better run of data this week. Home sales, GDP upgrades, lower jobless claims have raised the question of whether the Fed needs to cut rates at all. At face value next week, jobs numbers might back that up. You'd imagine most investors are braced for further weakness. So that's kind of like what the market is expecting. The market's expecting the figures to come out, like I said in this report, showing signs of cooling, right? But if we get a surprise to that data, so it says here, set against that 75,000 net jobs creation, our own forecast, so ING is actually forcing again higher reading than what the market is expecting, wouldn't seem so bad. And Chair Jerome Powell, don't forget, reckons the break-even rate of payrolls, that is hiring levels that would keep the unemployment rate stable. So if we did see again an uptick in job creation, stronger jobs data, it would likely again support the case for a stronger dollar, push back on the Fed rate cut narrative that the market is currently pricing in, as we saw up here. Where is it at? Traders are currently pricing in 2 to 3 more rate cuts next year, according to the CME Fed Watch tool. So we would likely see this scaled back. And what the Fed, you can see here, the Federal Reserve is projecting only one rate cut in 2026 would likely come into fruition. Markets would need to dial back those current or previous expectations. And what took place after Jerome Powell's announcement, September 17th, would likely continue to linger in the markets, and we'd likely see that way further on prices. All right. Just trying to give you guys some context. We also need to be mindful of a downside shock. That means if we get negative payrolls, this could spark temporary recession fears, which we've also seen given a historical context. So if you go back, this is the August blip, I like to call it, right here, where at the end of July, 31st to be exact, we had the unexpected rate hike from the Bank of Japan. So the market was only expecting a 25 basis point rate hike from the Bank of Japan. They hiked rates by 50 basis points. That led to massive unwindings of yen carry trades. And then shortly following that, after the week after, I think it was a Tuesday, or maybe it was a Friday, excuse me. It was a Friday. I don't know why I said Tuesday. Oh, Tuesday was the Bank of Japan release. Then that Friday, we had a horrible misprint in the NFP figures. So the market was expecting continued signs of cooling, but the jobs data actually came out substantially lower than what the market was anticipating, and that sparked recessionary fears. So most people usually coexist weaker labor market data with increased rate cut probabilities, which usually tends to boost risk assets. But in the short term, we need to understand that recessionary fears can create massive repositioning of safe haven demand in the moment and put sell pressure on risk assets. So again, I'm just trying to give you guys some historical context looking at previous, historical events. If we were to see the data this week in terms of labor market data scream recessionary fears, be prepared that yes, that would increase the probability of rate cuts, which long term would likely be bullish for risk assets. But in the short term, meaning intraday, we'd likely see gold substantially rally to new all-time highs, and we'd probably see larger investors sell off their risk assets, which, in my personal opinion, would be beneficial, eventually finding a floor and creating a discounted environment for larger investors to come in and scoop up everybody's fear to turn the market sentiment around. Same like they did back in August, right? When the Fed actually cut rates in September, anybody that was buying into that fear profited substantially. Right. So we'll then again be taking, at least I know I will. I can't give you guys financial advice, be taking up positions if we were to see those discounted opportunities. Right. Moving on. Another thing that we need to be mindful of is the government shutdown. Now, I'm happy that I was reading some reports this rising because I completely missed this. I didn't even know that this was ongoing. So right now, if we read this, it says, did I even put this in there? No, because I think Yahoo Finance was making my computer laggy. But anyways, right now there is the risk of a possible government shutdown this week, and the Senate set the vote on this, I believe, on Tuesday, if I'm not mistaken. I just want to give you guys the correct date. I'm pretty sure it's Tuesday. Investors will, yeah, it's right here. Investors will closely be watching negotiations over a government shutdown, which could occur if a deal is not reached by the Tuesday night deadline. So by midnight, we should understand whether or not this is going to happen. So without a Senate deal, the government could shut down at 12:01 a.m. on Wednesday, the following day. If that happens, we need to understand that key data like Friday's jobs report may not be released. That would add uncertainty in encouraging investors to move into safe haven assets like dollars, gold, or treasuries. Delayed data also complicates the Fed's October 28th to 29th meeting, making them more cautious. So you can see here in some of the reports that I was reading, it says September 30th, job openings, labor turnover data. Job openings have leveled off recently, although hiring is expected to pick up. So this is another report that I read that shows outside of what the market is expecting, which is cooling in the data, this data report is signaling an upbeat data report this week, which again would feed the narrative for a prolonged higher for interest rate environment. And then here this says non-farm payrolls likely accelerated from August, but will remain low, says Barclays economist. They also warn that a government shutdown could potentially delay the release of September jobs reports. Then here this one reads, the only realistic chance of avoiding a shutdown is for the Senate to pass the House-approved continuing resolution. Fund Straits policy strategist Tom Black wrote in a note on Friday. Block noted that since this resolution would be subject to a Senate filibuster, I don't know what the heck that means, the chamber would need 60 votes to get this bill through, which means flippening 7 Democratic senators, a tall order in just a few days. So we need to definitely be mindful of this because if we see a government shutdown this week, and if that were to lead to a postpone of the jobs reports this week, I'm just going to go outright and assume. I don't know this because I don't think I've ever lived through this. At least I don't remember it in my 9 years of investing experience. But I'm just going to go outright and assume it's going to create a high level of uncertainty in global markets, right? So based off of that historical context, when uncertainty heightens, we tend to see demand for safe haven assets. Where that safe haven inflow is going to come from, whether it be gold, treasuries, dollars, yen, who knows? But it's likely not to favor risk assets. Okay, so just be mindful of that. I thought that I'd throw that in this report because if this situation were to escalate further, then it's something that we need to be mindful of. And if not, and it's just a fugazi and they vote on it and everything's cool, there is no government shutdown, that could maybe spark some optimism back in the markets or just ease some of the current lingering uncertainties, which, we know tends to favor risk assets. So, all right. So despite headline inflation above target, Powell has signaled a willingness to cut another 25 basis points in October if the labor data continues to soften. Right now, the CME Fed Watch tool still assigns an 85% chance of an October cut. I highlighted that in bold. Without reading this further, can anybody tell me why I highlighted that in bold and why that percentage is important to pay attention to this week?
If the percentage drops, then there's going to be a little bit of weight on risk assets because it's already getting priced in.
Yeah, good job, Ron. Right, very easy. If we see this percentage chance drop, so I wrote here, but the odds profile could swing sharply depending on this week's numbers. If the odds of an October rate cut decrease, so just like what Ron was just saying, if the odds of an October rate cut decrease closer towards the 50% threshold, we can expect the dollar to strengthen and consolidation or sell pressure and risk assets. Inversely, if those odds increase, so if we see this probability chance of an October cut, a December cut, and then 2026 cuts increase, then it's likely to keep risk assets supported, lead to consolidation, and most likely weigh on the strength of the dollar, right? So, key takeaways to watch this week: cooling jobs data without any substantial decreases or signs of a collapse. This would likely be bullish for crypto, weigh on dollar strength, and support rate cut bets. We need to be mindful of the government shutdown. If it were to come into fruition, we need to be mindful of how the market reacts to that news. Does it add any uncertainty? Does it strengthen safe haven if the data is delayed? We know that if we saw a substantial amount of strength in gold or other safe haven assets, it's likely to reflect itself in sell pressure in crypto. Obviously, of course, any geopolitical flare-ups that spark a flight to safety are likely to be bearish for risk assets in the short term. So remember, we've seen recent freaking headlines mentioning World War III with the whole NATO debacle between Russia and the sanctions and all that stuff. If any of those things kick off and spark a flight to safety, we already know that that would likely deteriorate risk sentiment further, reposition larger investors to take profit and riskier bets, and position themselves temporarily in safe haven plays. And then, obviously, of course, any stronger than expected labor prints would likely be bearish for risk assets, strengthen the dollar, and reduce the likelihood of rate cut odds. So, to wrap this up, stay nimble around Friday's NFP and be ready for volatility spikes. Watch the US dollar and treasury yields as leading indicators. And this is not financial advice. Maybe I should change this to I will use pullbacks caused by temporary events as opportunities to reaccumulate high quality assets at a discount. Risk assets like crypto particularly need this week a Goldilocks labor market report, which would be a report that shows that data is cool enough to justify continued Fed easing, but not so weak that recessionary alarms ring. Anything outside that range, or a prolonged government shutdown that blinds the Fed and markets to real-time data, will likely strengthen the dollar or safe haven assets and pressure digital assets further, echoing the December 2024 pattern. So that's all that I have for you guys today to prep you all for this upcoming week. Let's take a look at current price action. So just going over the scenarios real fast. If we were to see, first covering the bullish scenario, cooling in the data, no geopolitical escalations or tensions, no tariff-related uncertainties, increased demand for safe haven assets. Profit taking in safe haven assets would be more favorable, and just a general environment that swings back optimism into more riskier bets. We're likely to see this recent floor that we've seen hold in previous months, July and August, as a key focal point area of interest. So that puts us at around $3.6 trillion. Wouldn't be surprised if we see a sweep of sellers. Buyers come back in, find support, show their hand, and we start to rekindle losses, making our way back up towards the $4 trillion threshold. Or we just see a continued move up from where we currently stand. On the lower time frames, this whole entire setup has already happened, and we just continue to rekindle losses from where we're currently sitting. Scenario number 3 is some type of temporary market uncertainty. Maybe we clear out more over-leveraged traders beneath these lows from July and August, find a floor underneath, and again, rekindle losses. These would be the bullish setups that I'd be looking for this week. Anything outside of that, meaning we see some type of government shutdown that leads to market induced uncertainty, we see elevated labor market figures that push back on Fed rate cut odds and dampen the further expectation of Fed easing. We have to bring the Bank of Japan into this as well. Any higher expectations that the Bank of Japan is going to hike rates, leading to unwinding of the yen carry trades or strengthening in the yen. Any uncertainty around geopolitical tensions, elevated tariff escalations, higher tariff announcements that lead to the market pricing in a higher probability of prolonged higher inflation, things of that nature, increased demand for safe haven assets in general. We're likely to see a failure to break back above the $4 trillion threshold. Maybe we do see buyers temporarily show their hand, but sellers coming back in to defend at previous positions, and we see a leg down, correcting more of the July move. And if we don't see something like this and the sentiment continues to sour, we're likely just to continue to see a downwards trajectory from where we currently stand, failing to find support at the July and August lows at 3.6 trillion, breaking that and trailing lower down into 3.3 to 3.2 trillion dollars to again trail back some of the recent bullish activity that we got back in July. So next area of interest, if the market sentiment does deteriorate further, while I would be looking for some good dollar cost average positions, is if we can come into this range of consolidation here before the market reaccumulated orders, broke out, tested strength of buyers down here, and started another leg higher. That puts us at around $3.3 trillion. So I'm going to set an alert and an alarm here just in case we do see a scenario like this. Remember that the rest of the market is going to be in complete chaotic panic mode because right now, with $330 billion gone from the market, I was looking at the crypto fear and greed index last Friday and it was sitting at 34. So I could only imagine what would happen to market sentiment if we were to scale back another $300 billion from the market and correct more of the July move. Man, it would be freaking chaotic in terms of sentiment from retail traders. But zooming out, looking at the historical context, in my personal opinion, we are still in a heavily bullish environment as long as we are above $3 trillion. So I'd look at this as our current bullish leg on the higher time frame, and that right now we've only seen, taking a fib on this, not even a 50% retracement of the bullish move from the June low to the August high. So if we were to correct further, this would put us at a 62% retracement from the June to August 2025 high, which in my personal opinion would still be healthy, right? So just be mindful. It's possible. I don't have a crystal ball, but what we do know based off of historical context is what will drive risk on, risk off sentiment. So we can be mindful of those factors and adjust our portfolio positions and mentality accordingly. All right. Outside of that, on the fundamental backdrop, though, that's all that I have for you guys. I will continue to give you guys updates in the fundamental section. Don't forget, Michael's section is really juicy with good updates and fundamentals to just read and digest, given the market sentiment. Before I jump into the snip verse, does anybody have any questions around the fundamental backdrop this week before we move on?